We all know that sugary beverages aren't exactly good for our health. High sugar intake is associated with an elevated risk of cardiovascular disease, diabetes, tooth decay, and a multitude of other health problems. The plastic containers these drinks are commonly consumed in produce millions of tons of waste per year. The burden of treating these lifestyle diseases and cleaning up this waste costs taxpayers hundreds of billions of dollars every year. The cost to the planet, one of devastation. Ultimately, it's your tax payments in mind that end up paying the billions of dollars needed to clean up this mess. The companies which created the damage, let's just say that they get off almost scot-free. Traditional accounting methodologies consider impacts like these the company's products have on their consumers and the environment to be externalities. This means that airlines can contribute to the destruction of the ozone layer, beverage companies can produce health-damaging sugar water, extractive companies can erode finite and unrenewable fuel resources, and the consequences of these actions never get reflected in their financial statements. But what if there was a better way of accounting? One that considers not only companies' financial operations, but also the impacts they have on people and planet through their operations, employment practices, their products, and through the supply chains which they operate. The good news, this improved form of accounting already exists, and it's called Impact-Weighted Accounting, or IWA for short. The pioneering work of impact-weighted accounting has been the product of cutting-edge research carried out at Harvard Business School by the Impact-Weighted Accounts Initiative, or IWAI for short, which was supported by the Global Steering Group for Impact Investment, or the GSG. At the end of 2022, IWAI's team left HBS to lead an important new entity, IFVI, or the International Foundation for Valuing Impacts. The IFVI has inherited IWAI's research and data. IFVI is creating standard valuations for the environmental and social impacts which companies create. Companies create impacts on people and planet through their operations, their employment practices, their products, and their supply chains. Impact-weighted accounting seeks to quantify each of these in monetary terms and bring them into financial accounting. To see how this works in practice, let's take a real-life example using actual data collected by IWAI. Note that this data originates from 2019. Using impact-weighted accounts, we can compare the environmental impact of the world's two most prolific producers of cola beverages, Coca-Cola and Pepsi. We can see that if Coca-Cola's environmental impact were expressed in financial terms, it would outstrip that of Pepsi by almost $2 billion and undermine its revenue performance by almost 12%. In fact, according to the 2022 Break Free from Plastic's Global Brand Audit, Coca-Cola is the worst plastic polluter in the world. The power of IWA will enable us for the very first time to bring the massive impacts which companies have across various domains into financial accounting, allowing companies' profitability to reflect not only their financial performance, but also how they affect their employees, their customers, their suppliers, and the planet. On board with the idea? Check out the work of the IFVI at ifvi.org and subscribe to Sir Ronnie Cohen on LinkedIn and YouTube for more Impact Made Simple videos.